Hi, this is Stephen here with Snap Projections to go over our newly launched corporate owned life insurance feature. I'm going to be using a plan today for Jane and John Snapper. Jane is currently 59 and John is 55. They're looking to retire in 2029 with a target spending of $125,000 in today's dollars. If we look over to the right, we can see the total personal liquid assets that they're expecting to have at the time of retirement. They'll have roughly 1.4 million personally. They'll own their home worth roughly 1.6 million, and then they'll have corporate assets of 3 million. As we continue down the planning page, we can see that the balances for their liquid personal assets and corporation remain fairly constant. So they're really just using their investment income each year in order to fund their spending goal. When we get to the final year of the plan in 2066, when John is projected to be 98 years old, we have a remaining balance of 700,000 personally, plus their home, plus 3.4 million in the corporation. If we go up to corporation XYZ, we can track how those balances progress throughout the plan. In the first year, we can see that Snap is automatically taking out enough money from the investment account to pay the annual taxes that have been calculated on the passive income. That continues until they retire in 2029. At that point, they're planning to take $70,000 as non-eligible dividends and 10,000 as eligible dividends. And we're indexing those values for inflation throughout the plan until Jane passes away at the age of 98. If we go back to the top, we can once again track the value of the investment account itself. We can see it starts at about 2.5 million, reaches a high of about 3.5 million, and then remains there throughout the plan until the end of the projection. Now, one thing that we want to explore with Jane and John is whether converting some of the money in their corporation into a whole life insurance policy could create a more tax efficient distribution of this excess cash to their final estate. So we're going to come up to the top of this plan and click copy scenario. And then we're going to run a second scenario where we use corporate insurance to see whether they might be better off using that strategy. So I'll just update this name to corporate insurance. Then I'll go into corporation XYZ. When I click on scenario setup, I can then go into insurance. This is just like on the personal side, we can now add policies that have a beneficiary of the corporation. So I'm going to add insurance policy. I'll just call this corporate policy. I'm going to select whole life policy. For the insured individual, we will need to select either Jane or John. Similar to on the personal side, we just need to tie it to one life within the projection. In this case, I'm going to set it as John. Because John is the last to pass away in the plan, and this is a joint last to die policy, we want the timing to align according to when they're going to pass away in the plan. If both individuals are passing away in the same year, you can select either or for your policies. Once we've selected all of that information, we can then click on Edit under Death Benefit, and that's going to bring up our input page. Just like on the personal side, we don't need to enter these values manually. We can simply copy from any table, either our quote provider or from an Excel sheet, and we can click in the first year and paste those values into the plan directly. You can do that on a column by column basis or all four columns at once if you have it structured in that way in your spreadsheet. I'll close this and then proceed back to the planning page to see how that will reflect in the plan. We can now see a corporate policy on the planning page of our corporation XYZ. We have the death benefit, the cash surrender value, and the premium each year of the plan. As we hover our mouse over top of any of those values, we can also see the adjusted cost base for the policy. Now that we've added the premium to the plan, we can see that Snap is withdrawing additional money out of the investment account to both fund the taxes that it was doing previously and pay the annual premium. That continues until the premium stops, and then Snap goes back to simply paying the dividends and the taxes. As we continue down in the projection, we can see that because we've made those larger withdrawals in the early stage of the corporation, we're now left with a balance of 2 million instead of 3.5, and we've converted that money instead into a death benefit of roughly 1.6 million. If we go back to the combined page for a moment, we can get a sense of whether this would be a preferred strategy for John and Jane. We have the personal estate before tax column. We can click on this value in any year in order to look at the breakdown of the client's estate and compare it to other plans in the software. So I'm going to go to the final year of the projection and click on this estate value. In our current plan with the corporate insurance, when John passes away in December 31st, 2066, they're expected to have an estate after tax of roughly 2.3 million. That's taking a total asset base of 7.9, paying 600,000 in taxes, and then leaves their beneficiaries with 2.3 mil or 7.3 million. I can also click compare with other scenarios, and that's going to show us what the previous case was going to be with corporate investments alone. So at the end of the plan, when John passes away, they were going to have about 7.7 million in total assets and a tax bill of roughly $1 million. So we can see that by adding the insurance policy to the plan, we've increased their after-tax estate value by about 500,000, and that's primarily through reducing the taxes payable in the final year of the projection. So in this case, it looks like the insurance policy may be attractive for John and Jane. If we go back into the corporation, we can see the similar information on the right-hand side of the planning page. So we have the net worth of the corporation each year of the plan. We can scroll down and see that value. This is simply taking the balance of all assets plus the cash surrender value, less any of the debt that might be in the corporation. So this is the value of the corporation while the client is alive. And then this column is the value of the corporation if they were to pass away in that year. So we can click on the final year for the corporation and see how this would be wound down in this particular strategy. So we have capital assets of 2 million. We have the insurance cash surrender value of 1.1, which brings the net worth of the corporation to 3 million. We would then make an approximation of taxes payable on disposition and the expected refunds from distributing money out of the corporation in the final estate. And that brings us to our market value that is used for tax calculation purposes. So this would start off as being a deemed disposition to the estate for 3.2 million, and there would be a capital gain unless it's being offset by distributions later on in this spreadsheet. We can see the insurance cash surrender value is then removed from the market value since we're not actually receiving this value, and the insurance proceeds are added. That brings us to 3.7 million, which is the total cash that the corporation would have available for distributions to the estate. It would then pay 2.5 million in capital dividends, and up to 50% of the market value that was deemed as a capital gain would be offset through that capital dividend distribution. Then Snap would move on and pay eligible dividends and non-eligible dividends up to the allowable limits, and those would also offset the capital gain calculated in the first step of the estate tax calculation. So we're doing the tax calculations appropriately, making distributions out of the corporation's cash in the final year, and that can be any combination of return of capital, capital dividends, eligible dividends, and non-eligible dividends. And it does look at things like GRIP balance, RDTOH balances in order to do that on an efficient basis. I'll close out of there and then go back for a moment to the personal side, just so that we can make sure that we understand how the corporate information is reflected on the personal side. The corporation column that we see, this is the same value that shows in the net worth column. So this is how much the corporation is worth each year of the plan while they remain alive. Then when we click on the estate before tax value in any given year, we can see the corporation value here is what would be available to the estate. So this is actually the cash distribution that's expected to be received after all of the insurance proceeds and everything else is handled. And if we hover our mouse over top of any of the values, we can see how that corporation is expected to be distributed through to the end recipient. So in this case, they would receive 1.8 million in capital dividends, 200,000 in eligible dividends, and 1.7 million in non-eligible dividends. And that would then factor into the taxes calculated for the estate. So at this point, we've been able to go through the corporate insurance policy. One other change that has occurred with this release is that we've updated the tax assumptions for the corporate disposition itself. So previously in SNAP, there was a single method of tax calculation for the estate, and that was referred to as share sale. What that meant is that in the final year of the estate, Snap assumed that the corporate shares were sold for the net worth of the corporation and that a capital gain was realized by the estate for the value of the shares sold less any adjusted cost base that had been input in the software for those shares. So previously, the calculation for the corporate taxes was on a capital gains basis. With this new release, we're introducing a new method of disposition called winding up, where instead of assuming that the net worth of the corporation is realized as a capital gain, we're going to use distributions from the corporation to the estate in order to calculate the net of tax proceeds for the estate. So this winding up method is what I just went through, where we showed the cash available to the corporation and then a distribution of various dividends in order to get the money to the personal estate. You can select between those two options. However, in order to use corporate insurance, we do need the winding up method to be selected. In addition, the winding up method does a better job of allowing us to compare different corporate strategies where notional account balances are different in the plan. If we go to the corporate planning page, we can go to balances and see that the RDTOH, CDA, and GRIP balances are tracked throughout the projection. You can also input any existing balances for these values into your plan, and these are tracked throughout the projection. So previously, if we were just assuming that the shares are sold in the final year, these balances didn't play a role in determining the value of the corporation to the end client. Whereas with winding up method enabled, which is our new default, these values will impact the ultimate after tax estate value of your client's projection, which will make it easier to compare different strategies to see what to recommend for your client. We've also added an insurance policy page to the client report under the corporate section. So we can see the insurance policies can now be displayed here. And we also have lots of additional exciting resources coming very shortly. So there's a lot to go over with corporate insurance and corporate planning in general. We do have an upcoming webinar that you can sign up for by going to help and then help center. You can go to webinars, and then you'll see at the very top, we have a March 1st webinar where we'll go over the corporate owned life insurance. You can come in here, register for the event. If you aren't able to attend in person, that's no problem. We'll be able to, or not in person, but live, we'll be able to send you the recording the same day that we finish the session. And then we'll also update this article with the recording so that you can watch that in the future when you have time. We really look forward to hearing any feedback that you have on the feature, what works well, what you'd like to see in the future. If you have any questions or feedback, you can give us a call or you can send us an email by clicking contact. You can also search for additional helper articles that we will be launching over the next week, and we will be here to help fully support this feature and answer any questions that you might have. Thanks very much.